Well, good morning. Welcome back to the Broadcast Retirement Network. I'm Jeff Snyder. This is BRNAM for Wednesday, May 17th, 2023. And our top story today, we're going to break it all down. Economic data, market volatility, rising rates, and what it means for long-term retirement investors. And joining me now to discuss this and a lot more, Kristina Hooper is the Chief Market Strategist for Invesco. Kristina, great to see you again. Thanks so much for joining us on the program this morning.
It's great to be with you, Jeff. Thanks for having me.
Yeah, really looking forward to catching up with you. Look, we just got some GDP numbers. We've got low unemployment, volatile stock market, and rising rates. And I guess I want to start off with the baseline here. What's your perspective, and can you help us break down what this all means for retirement investors?
Well, we're clearly in a transition. We went through a really extraordinary set of circumstances with the pandemic, and that meant not just monetary stimulus coming from the government, but fiscal stimulus and massive amounts of it. And the United States wasn't alone. Other major developed countries went through the same experience in terms of pumping a lot of stimulus into the economy to compensate really for the traumatic shutdowns created by the pandemic. It's natural to then see this enormous surge in inflation when economies reopened. There was a lot of money out there chasing very few goods and services, relatively speaking. And really the definition of inflation is too much money chasing too few goods, or at least the simple definition of inflation is that. So then, of course, we saw central banks react to that high level of inflation, maybe waiting a little too long and then getting extremely aggressive. And so we've seen just a massive amount of tightening on the part of many central banks over the last 14 or so months. And so here we are today in an environment where rates have gone up dramatically. I think I have whiplash from the amount of aggressive rate hikes we've seen. We also have an economy that is clearly slowing as a result of those aggressive rate hikes, but we also have an unusual set of circumstances in terms of the labor market, where we've really had shortages in a number of different industries. So the labor market remains tight. Now, that is, to me, an economy that is poised to continue slowing down. We're likely to see some weakness in employment going forward. That's certainly the aim of the Fed. We're likely to continue to see a slowdown. And at a certain point, because I do believe that central banks, especially the Fed, are going to pause. In my opinion, the Fed has already initiated a de facto conditional pause. So what we're likely to look out on is this downturn that then is followed by a recovery. So for retirement investors, they tend to have a longer time horizon. Even those who are in retirement are likely to live much longer. And so they don't have to worry about where we are in the economic cycle today. What they do need to understand, though, is that what has happened with rate hikes has created a far different and far better environment for fixed income than they've seen in many years. And so in some ways, the picture is better for retirees because income yield is more abundant.
Well, Kristina, just to follow up on that, and one of the things that we've talked about with Greg Jenkins and others from Invesco is retirement income. I'm sure you recall the research, Show Me the Income, and we've talked about that numerous times with your colleagues. Interest rates play a big part in retirement income products, specifically because their underlying investments are fixed income. How does all this factor into an investment manager's, meaning how do the rates and the Fed changes, increases, decreases, how does that all factor into an investment manager like Invesco in terms of managing its products?
Well, it really doesn't change anything we do, but it does create a better environment just because income is more abundant. But the reality is that what we're doing is looking for the most attractive securities in a given portfolio, given that mandate. I think the bigger picture, though, is that this is an environment in which we're no longer in what has been termed TINA. There is no alternative. And that, of course, was referring to equities. Now fixed income is a lot more attractive. It's a lot more competitive relative to equities. And I think that many investors are going to be much happier with a diversified portfolio, with adequate exposure to fixed income as well as equities than they have been in years because of this abundant yield environment.
And you mentioned yield, and I want to ask you just to take the theme a little bit further with interest rates. A lot of the conversation going on, and you see it on all the major networks and in meetings, I'm sure, is the inverted yield curve. And I want to talk a little bit about what that means. And I need a refresher and what it means, and also what's it mean for retirement investors today?
So, the inverted yield curve is a great, rather accurate signal for whether or not an economy is going to go into recession. Now, there are different segments on the yield curve, but the one that is probably most followed is the 2s, 10s yield curve. And that is the 2-year bond and the 10-year government bond. And in a normal environment in which we anticipate an economic expansion, what we would see is that the 2-year yield would be significantly lower than the 10-year yield. That is a normal yield curve. But when a yield curve gets inverted, when the 2-year yield becomes higher than the 10-year yield, that is signaling trouble in an economy because the assumption is that further out, growth will be lower, and that's why the yield on the 10-year is lower than the 2-year. So in that environment, investors become cautious, and with good reason, right? Because it has been so predictive historically. Now, if you look at some of the Fed research, they would argue there are different yield curves to look at, the 3-month, 10-year, but all of these yield curves really are signaling that we are going into an economic downturn. We're likely going to see a recession. Now, what does that mean for retirement investors? Well, I don't think it means too much for them. Again, I think the most important thing is that yields have gone up significantly, that overall the yield curve has moved up, and that's important. What we're likely to see, of course, in what markets are anticipating is that at some point, the short end of the curve will come down, that we are likely to see the Fed cut rates at some point because it has driven the economy into a downturn. Or, the alternate scenario is that it is comfortable enough with the progress of inflation that has gotten that the disinflationary trend has taken hold and inflation has gotten low enough that it can cut rates. So at some point, we would anticipate that rates on the short end would come down. We would go back at some point to a normal yield curve. But for the purposes of investors, I think for retirement and retirees, for retirement investors, really the key takeaway is that we are in a higher yield environment. And that's really important because we haven't seen that in years and years.
Yeah, I think I had hair back when that was happening. Kristina, I need to take a quick break. When we come back, we're going to talk about the 60/40 portfolio and a lot more. You're going to want to stay tuned right here on BRN AM. Imagine a new television network that will make you richer, healthier, and in control of your financial future. This network is for the policewoman in Nashville, Tennessee, the baker in Dubuque, Iowa, the teacher in Lexington, Kentucky. We want to make the idea of savings and retirement culturally relevant. But what do you see as a defining issue of the midterms, especially for the smaller businesses? I mean, they are the lifeblood of the American economy. Featuring exclusive interviews, current affairs, and docuseries. 33 years old, you retired early.
The philosophy is money only matters if it helps you live a life that you love.
But you got to start thinking about retirement as soon as you get in.
The Broadcast Retirement Network will drive very high engagement with premium partnerships. So this isn't retirement and savings for your parents or grandparents. This is for all Americans. And we're going to change the way you think about money. Welcome to the next frontier of retirement and savings. This is BRN, the Broadcast Retirement Network.
Are you stuck with a low credit score? A credit report and score that's causing you to be denied credit or pay higher interest rates than others for the same things? Then do what Terrence did and call Credit Repaired for your free credit evaluation to help restore your credit.
I started thinking about buying a new house, and my score wasn't where I needed it to be. I called and spoke with one of the representatives, and we just had a good conversation, and I liked what he was saying.
Just one call for his free credit evaluation was all it took to start back on the track to repairing his credit.
I'm seeing the deletions and I'm getting the report, so I know something's being done. It does make a difference to me.
All it takes is one call to get started.
Credit Repair has given me a second chance to have a better credit score.
Don't let a low credit score hold you back another day. Do what Terrence did and make the call for your free credit evaluation.
Call 800-819-4152. That's 800-819-4152. Again, 800-819-4152.
Welcome back. We're joined this morning by Kristina Hooper. She's the Chief Market Strategist for Invesco. Kristina, thanks so much for sticking around with us this morning for segment number 2.
It is my pleasure to stick around with you for segment number 2, Jeff.
And I'm so excited. I have to tell you, I've never lost a guest yet. I mean, I guess I suppose it could happen, but in over 1,200 shows, we haven't lost a guest yet. So very excited to have you. Kristina, most retirement investors and investors in general are really familiar with this 60-40 stock bond split. And there's been a lot of debate just because of the way the market conditions have been, the volatility that you talked about, I think, in segment 1. And does it still work? And I want to start off, my first question is, what's your take on that? I mean, do we need to abandon 60-40? 70-30, go to another allocation type?
So, Jeff, that question was something we got a lot at the start of 2023. And really, we continue to get because of 2022. It was a miserable year for equity investors and fixed income investors. I would argue it was even rougher for fixed income investors because usually equity investors assume there's going to be some volatility. There could be down years. Fixed income investors don't anticipate that. And yet we had a really, really rough year last year. Now, I don't want to sound like a broken record, but what we went through last year was a result of aggressive tightening. And that's really what sent fixed income down. It made it it made a tough ride for fixed income investors. But it was that pain last year that has set us up for this much better environment this year, where, as I said, yields are in abundance compared to where they have been. And so that actually, ironically, has made 60-40 portfolios a lot more attractive. And really, it's making up for, I think, a lot of the pain that fixed income investors experienced last year. Now, having said that, we've argued for years that 60-40 isn't diversified enough. That there needs to be some component of most investors' portfolios, whether retirement or not, that has alternatives in it, if only to provide some level of diversification, some lower correlating asset classes to smooth the ride and at times enhance returns, or at least increase the potential for returns. So that to me is a much more prudent approach, for most investors having that alt sleeve. And for some, it could be something like 50, 30, 20. For others, it could be a smaller component that's alternatives. It really depends on risk tolerance and age. But I think at least considering alts in there makes a lot of sense.
Going back to inflation, and you made the point that we're facing really inflation, a considerable amount of inflation that we haven't faced in a long time. I mean, I lived through the 70s and 80s, and I remember some of that high inflation. And that inflation has an impact to retirement income that you've already talked about. What about this 5% inflation? Is it longer? Is this a long-term reality, or in this economic cycle, will this be a shorter reality, and maybe the Fed will take action and actually help reduce the inflation over the short term?
So, Jeff, I think we have to think about inflation in terms of different components of inflation. And this is actually something that Jay Powell has promoted, this idea that we can decompose inflation into different segments. There is goods inflation. We really saw that first, right? Because during the pandemic itself, during lockdowns, money was chasing goods because people weren't going out and they weren't spending on services. And then what we've seen is a shift towards services spending. That has been the source of money really since companies have reopened. That has been the main focus of spending. And then, of course, there's also housing, which is a component of services, but we can break that out because there are different dynamics there, and that's certainly impacted by where mortgage rates are. So what we've seen is that goods inflation has come down, right? We started spending on that, and when we moved to services, we spent less on goods. There are other parts of the equation as well. You had lockdowns in China last year. Well, now China has reopened. And so, for example, if you were to look at the Global Supply Chain Pressure Index, which was just updated as of April 30th, what it shows is that global supply chain pressures have fallen dramatically. So if we were to look at commodity prices, many of them have come down. So goods inflation is no longer a concern. We've seen a lot of disinflation there, and I think Jay Powell would even say that's not at all a focus. So then it shifts to housing. And certainly high mortgage rates have played a role in depressing real estate in general. Shelter costs are still elevated, but I think Jay Powell's fairly comfortable with the fact that they're starting to roll over. Now, there are structural issues. There's not enough housing right now, and that's not remedied right away. But in general, I think what the Fed's focus on, what it's concerned with, is services ex shelter. And that's because so much of that is driven by people and wages. And that really is the big concern. You know, Janet Yellen argued that wage growth was the stickiest part of inflation. And so that's the real concern right now. But we're seeing, you know, some improvement. It's not improvement every single month. This is a lumpy kind of disinflationary process. And so there are going to be spikes, there are going to be disappointments, but the trend is down. And so I believe, and this might seem a little controversial, but I believe inflation is a rear view mirror issue. The Fed has done enough in the last 14 months. But there's a policy lag, but it has done enough that it will drive down inflation. What I think the Fed needs to be concerned with is more recession. I think inflation is in a very significant trend, and I don't think it's going to be a major problem going forward. In fact, it may not even be a minor problem going forward.
Well, that's certainly good news for retirement investors. Last question, and really picking up on the 60-40 conversation, you brought up alternatives, and there has been a lot of talk about democratization of alternatives so that it's not just high net worth clients, it's actually retirement investors. Assuming that the structural issues, and by that I mean liquidity, you know, how do you bring that into a retirement plan? Is it part of a target date fund? Assuming those things are all solved, and I think for the most part they are, is this a good thing for investors of all stripes to be able to have access to within their workplace retirement plans?
Absolutely, but with adequate education. Because I think that it is wonderful to have access to different asset classes within the alternative space. But it's also important to really understand the role of these asset classes in one's portfolio. Does it really offer the kind of diversification benefits that you would want? What kind of risk reward profile is it? I think with access to investments comes an obligation to really understand them well. So I think there's an education need, an education opportunity for some of the less well-known, less understood alternative sub-asset classes. But I do think it is a good thing to have access to that and to have a democratization of alternative asset classes.
Yeah, it just makes sense. If you're doing it in a defined benefit plan, endowments and foundations, why not the DC plan as well? Kristina, we're going to have to leave it there. I could talk to you for hours, but we really appreciate you coming on the program, and we thank you for sharing your perspective.
Thank you, Jeff. Really appreciate it.
And that wraps up this episode of BRNAM. Have a topic of interest, someone you think we should talk to, drop us a line. And don't forget, for all the latest curated news in lifestyle, wellness, finance, tech, so much more, all in one place, check out today's edition of our daily newsletter, The Morning Pulse. Want to search our archives, check out our latest content, we'll visit our website, and of course, all of our 300 streaming partners. We're back again tomorrow for another edition of BRNAM. Until then, I'm Jeff Snyder. Stay safe, keep on saving, and don't forget, roll with the changes. Now is your opportunity to co-create content around any topic on the first lifestyle and wellness network. Reach a global audience through our platform and co-own exclusive branded content. All of our programs are available on demand and also as audio-only podcasts, so you can take us on the go. Broadcast Retirement Network, available anytime, anywhere, and on any device.
Tax audits, tax liens, wage garnishments.
Every day we hear stories like this about good folks who are simply struggling to pay their bills. Each of them are living a frightening IRS tax nightmare, and they are afraid it will destroy their lives.
I'm a divorced single mom, and my ex-husband left me and the kids with a lot of unpaid bills, including unpaid taxes. I was really starting to show my stress on my kids because the IRS had sent me a letter demanding a huge payment from me. I couldn't afford it. So then the IRS was threatening to garnish my wages. I'm already living paycheck to paycheck. That would have put me over the edge financially.
It truly seemed hopeless, but then a friend at work told her to call the tax relief line.
The people at the tax relief line, they told me about something called innocent spouse relief. They worked it out so that all of the taxes from my ex are not my problem. I don't know how that works, and I don't care. All I care about is that I don't owe the IRS a dime, and they are not going to take my paycheck.
Even if it seems hopeless, you should call the number on your screen right now. There is absolutely no cost for the call or the consultation. You are under no obligation. If you are worried that the IRS could garnish your wages, seize your assets, even take your home, call us right now. The Tax Relief Line is here to help you. Now you have a knowledgeable, professional team of tax experts that are ready to negotiate with the IRS and fight for you to save you money. The Tax Relief Line's professionals have successfully negotiated thousands of cases, reducing and sometimes even eliminating the tax debt for their clients. It's very easy to get started. Simply call the number on your screen right now. You don't have to live in fear anymore. The call and the consultation are free.